Hey everyone, this is Kirk here again from Option Alpha. This is the members only video for the weekend. And what I wanted to do on this video is go over a couple things. Obviously, this week was pretty whipsawing for most of you, myself included. It seemed like early on in the week that things were going higher, and then later on in the week, obviously, things took a turn. So now stocks are really at a 5-week low. They've been trending lower for the last 5 weeks. Now, historically speaking, it should be looked like it might be a week or two up here, small, like 1-2%, nothing really major. But that's just the historical averages after the stocks decline about 5 weeks in a row. So the next 1 to 2 weeks are usually positive on average. So that's what we're going to be looking for. Again, looking at the probabilities and the statistics, not really taking emotion into account. What I wanted to just touch on real quick is that if you were a call buyer or even a put buyer these last 2 weeks, you really got burned unless you got in and out of trades very, very quickly, because the market went right up and right back down, and we're virtually at the same place that we were back on 5/25, so May 25th. So it's pretty interesting that unless you got out real quick either direction and timed the market almost perfectly, you probably lost money as a put buyer or a call buyer because of the time decay factor in there. Now, you may have gained a little bit on volatility, obviously, but you definitely lost on this. And again, the market went nowhere, and that's not good for you. So for us, it's been really good. I think that, all the recent volatility just moving basically sideways over the last 2 weeks has been great. That's perfect. That's exactly what we want to see for the most part. We don't want to see the market too volatile, obviously, but moving sideways is going to be really good. For our credit spreads, you can see on the RUT, we're well positioned above and around the market, so not really concerned about that. On the SPX, again, well positioned below the market. On our naked portfolio, you can see that we have mostly puts for June and starting to enter July puts, obviously. The iron condors, again, on the IWM, really, really safe trade at 89 and 74. So a little bit more downside room protection, which is great. And again, the market moved virtually sideways. So everything looks really good for our portfolio going forward. You can see we're well below the market on most of these trades here. So a lot of ample room to the downside, and I think that that's going to be the biggest pressure area going forward. I think for next week, what we're going to try to do is really enter a lot of trades early in the week and get some trades off for the naked puts and calls in particular and credit spreads. I'm actually going to try to enter about 2 trades next week. So be on your toes next week for trades coming out. I want to get some of these trades in before we get too far into the expiration cycle. I know that the VIX has had a little bit of jump up, and I call a little bit of jump up these days a move from 15 to 17. And that's really not that big in the grand scheme of things, but it's had a little move up, and so hopefully we'll get a little bit more volatility, which will allow us to get wider from the market. Okay, now what I really want to go over tonight, and like I said in the email, is a look at just one of our credit spread type situations. Now, obviously, we don't show an alert for 10 contracts. We only show an alert for one contract per side on a credit spread, and then you can kind of increase that as much as you want depending on your portfolio. But what I want to go over tonight is that adjustment that I had talked about in the last email, and it's a really good trick. Depending on your portfolio, obviously, this kind of works if you have a little bit more contracts. If you're just trading one full credit spread, one contract all the way around, might not work. You just have to kind of run the numbers and take a look. But this is a really good technique for when you have a situation like we're in, where it could be a little bit more volatile. There's a little bit more downside risk because of the recent activity in the week. So you want to take some protection, right? You want to make sure that if the market does have a huge move lower, that you're obviously covered. Now, with credit spreads, naturally, right, we're limited to the downside. But we want to also possibly turn into our favor so that we can make money on the downside on a volatility move or a Vega move. So right now what I have on my screen is just a simple 720, 715 put spread on the RUT. And again, this is one of our credit spread trades, and numbers may not work out right now, but this is what kind of the spread was when we entered this trade. It was $20 difference. These actual individual prices may be different depending on when you got fills, but the difference between them was $20. So for this, what I'm looking at now is just 10 contracts on either end. So you can see up here on my profit loss diagram in Thinkorswim that it's a very neutral position, right? It's pretty traditional credit spread in the fact that it has limited upside and limited downside, right? And that's this blue line here that you usually see when you see the profit loss diagram for a credit spread. So anything below really 710, 715 here is limited to the downside. And then again, anything above 720 is our profit at expiration. So right now the RUT is trading at 808, which is right here where my cursor is, this dotted red line. So we definitely have some room to the downside. But what our risk is right now is that we have a huge move in RUT in the next couple days, and you can see our intraday loss may be a little bit higher, and that's because of the volatility move, the Vega move, right? And it starts to get over here. So this red line here is actually the intermediate profit loss, and this takes into account all of the time decay that's left in the option and all of the volatility. So what I had suggested to members is that instead of leaving this position on, if these short options are really cheap and you can buy them back, right? Maybe buy back one or two. So let's just look at buying back one of the short options. And what this is going to do is create an unbalanced credit spread here, and basically a ratio back spread is what this is called. So we're going to take off one of these spreads here. Oh, clicked the wrong way. So we're going to take off just one. So now we have 9 short, and we're leaving all 10 puts in there, right? We had anticipated on losing on these puts anyway, but now we're going to use them to our advantage. So you can see this changes the whole profit loss diagram of this credit spread. No longer is our profit loss limited to the downside past 715. So now we actually have an unbalanced portfolio where we have just a little bit more long puts than we do short puts. And again, what this has done is create a whole new profit loss diagram so that if we do see that dramatic, huge move lower, and that's really what we're risking here always with the markets, that kind of black swan type of event, then actually we're going to make money on this position. Now, we're going to make money on this position on an intraday basis and try to close it out early. And again, you can see that this red line, which is the intraday kind of profit loss that takes into account the remaining time decay and volatility, is now positive regardless of how far down it moves right now. So this line is going to get closer and closer and closer to match up with this blue line here, which is the actual expiration line. But the idea is to protect from that sudden move down lower in the markets, and all you're going to basically do is just unbalance your credit spread. So again, this is a little bit more of a advanced technique for some of you, but as always, it's something to definitely take a look at, is creating this kind of unbalanced look. Now you can do it with more positions if you want to, like let's say you want to do 2 contracts or even 3 contracts, and you can see that's even more unbalanced. It just gets even more unbalanced, and now anything really below 704, you're actually making a lot of money if the market just absolutely falls apart. So it's a really good strategy, but obviously you have to run the numbers to make sure that they actually work and that this works out in your favor, right? You don't want to make something too unbalanced to where you're actually now becoming a major put buyer at these levels. So as always, hope this is helpful, and you guys can email me with questions or comments, and happy trading.